Hello, this is Mike Swanson of Wall Street Window. The odds are that you're watching this video, but you got an email from me telling you that's up and it's on YouTube. Now, if you're not on my free email list, scroll into the description of this video and you will see a link to get my free weekly newsletter, completely free. I was talking about gold today. I have roughly 14% of my accounts invested in gold and silver ETFs. These are metals ETFs. They're not mining stocks, although I do own some mining stocks too. But I see this as part of an overall investment strategy. I've got regular stock market investments too. I've got bond investments too. I'm bullish on gold. Many other people are bullish on gold. And you can go and type in and watch endless videos, I'm sure, of predictions for massive gains this year, all over YouTube and articles on the internet. But there's other reasons beyond that and why I've got 14% of my money now in gold. And that's what I want to talk to you about today, this year, 2024, and the next couple of years, because I think gold investing is going to become a necessity. Here's a chart of gold as we're speaking today on the 10th. It's roughly trading around 2050. Back in September, it was below 1850 for a short amount of time. But most of last year, it was trading in a range between 1925 and really 2000. And we're above that 2000. So that's bullish, in itself. If we go back from 1999 or the summer 2000, when the NASDAQ had a big tech bubble top, internet stock top, gold has outperformed the Dow since then. And gold has been less volatile than the stock market, too. When the S&P 500 fell over 30% in 2020 in the spring, gold fell roughly half that much and came back quicker than the S&P 500. So gold is actually less volatile than the stock market, and in times of turmoil acts as a source of stability in a brokerage account. That's why I've got 14% of my investments allocated currently to metals. And if you look, last year was a good year for the stock market. As I've said in the last two videos, I'm not bearish on the U.S. stock market this year. I think we can see a continuation of the cyclical bull market, and I believe we're in. And that's what I said, I think, in the last year. We're starting a cyclical bull market. When everyone else was so negative because of what happened in 2022, I shifted positive early last year, and it remained that way. If things develop and make me change my mind, I will. I look at the charts and adjust my views based on them. But what I want to point out to you is what happened in 2022. Bonds fell when the stock market fell too. In fact, the decline in bonds helped drive stocks down, because when bonds go up, the yields that they have go down. And when yields go up, bonds go down. So interest rates were going up in 2022. Bond prices went down. What you're seeing is exchange traded fund TLT, and TLT fell. Almost all bond funds fell in 2022. Those losses continued for bonds while the stock market was positive, though, in 2023. And we've seen a bottom in the bond market form in October. I think it's going to be a short-term bottom, but it's likely to last for all of this year, which is good for bond investors. Why? This has everything to do with gold, though. You see, gold, historically, gold goes up and down. Most of it's driven by changes in the value of the US dollar. You see, gold is a hedge for when the dollar falls in value, gold goes up. Historically, that's what it's done. And I'm going to demonstrate this to you with this indicator I just put on the bottom of this chart. It's a correlation indicator measuring the price relationship between gold and the US dollar index, USD, on a 200-day moving average basis. Okay, that all sounds complicated. It's very simple. When this indicator is at 1, flatline, it means the things are trading exactly lock, stock, and barrel together. When one goes up, the other goes up. When it's negative, they trade opposite to each other. Historically, this indicator is fairly negative, close to 1. Trades below 7.5. So gold is a hedge for a day. Gold can go up and down. I'm bullish on gold, but gold also is a hedge against declining U.S. dollar. And the U.S. dollar index has had a rally last year, and it's been in a decline since October. A nation's value of its currency is often linked to the debt situation that nation is in and interest rates in that country. When debt's low, it helps generate strong currency. When rates go up, it helps the currency too. When the opposite two are happening, that's bearish. And now we're shifting into a situation where interest rate, the last hiking cycle is basically over, and debts in the United States are going to grow. I'm going to show you that in a second. So that's long-term bearish for the US dollar, and that can hurt investors in the United States because that can generate inflation down the road. Now, I don't think this is going to be a problem this year, but down the road, it can become a problem. It can happen unexpectedly to people. This will hurt the value of bonds, and be I think, a big potential problem. So I own bonds in my account. I got some CDs in my account, but there could be a day in which this becomes a big problem, and gold will go up and help hedge those positions. In fact, I've mathematically, the calculations are, I've looked into this in what happens in other countries. If there is a currency crisis in a country, in the currency declines by about 30%, typically gold will go up 2 to 3 times in value in that nation's currency. So, that's basically what you need to do to hedge. And that's what I'm doing. I'm bullish. I think I can buy this and make money. I've done it before, but I think it could be something that's very important to own. Let's get deeper into this topic. Here's the national debt. As I've been doing this video, it's gone up probably several $100 million. That's how quickly the debt is growing. Each taxpayer's share of that debt is now almost $1 million. Okay, you've heard about this over and over again. It's been a fact of life, but it's growing now into a crisis situation. Again, I don't think the crisis is coming next week or next month, but I think it's going to hit when there is another recession in the United States. Maybe that comes after the presidential cycle. It looks like the Biden, the Fed are going to do what they can to keep the market up, keep investors happy and excited, in the economy doing okay. But there will be another recession one day, and when it happens, we could have a big problem. The last time it happened, what you're looking at is a chart of in the United States. This is Federal Reserve information. FRED is the St. Louis Federal Reserve Economics website, economic data for the public. This is the Federal Reserve's data. And what you're seeing is the percentage of that total debt to GDP. And it's now over 100%. It's at 120%, in fact. So that's an elevated level. It's the highest level since World War II. It actually surpasses the World War II level. And history shows that economic crises occur in a country when this gets up above 120%. It can get close to 200%. That's the situation in Japan right now. But doesn't mean it comes It's an indicator, doesn't tell you, oh, it's going to happen as soon as you get above the level, but it says this is danger, danger, danger. And you're walking at night with the lights off, and you don't know when you're going to hit the wall, but it's going to happen. And the situation is getting so big now that the interest on the debt in itself has now surpassed the amount of money spent on many government federal programs, passing the amount of money spent on Medicare in 2023, passing veteran spending, passing SNAP, passing spending spent on children. It's good. It's poised to pass this year the defense budget, and then eventually within 3 years to pass the amount of money being spent on Medicare, to become the biggest component of the federal budget. Simple interest on the debt. And now it's difficult to predict the exact year, the exact month that's going to happen, because the amount of money that the federal government takes in can go up and down depending on how much they get from tax revenues. So when a recession hits, tax revenues decline, and if there's no cut in spending, boom, the budget busts even more. That's essentially what happened in 2020, and why the next recession, when it does come, can put the U.S. government, the federal government, in a big crunch when it comes to its budget deficit, when it comes to this component of the budget, the net interest payments, and it can just balloon and blow up. And if that occurs, expect the U.S. dollar index to decline. I think it can go down this year very slowly, not really be a visible problem to the public, and create a, help push up the price of gold, help push up the price of silver, and like a stealth rally that the masses ignore, but the people inside gold and silver benefit from. But a day can come when the next recession hits, and say it's in 2025 or 2026 or 2027, in which it becomes a problem that impacts the bond market, that makes bonds go down in value like they did in 2022, and causes a lot of problems. And that's why I have dedicated in my account of roughly 14% for metals ETFs. Not simply because I think it can go up, but because they act as a hedge for traditional investments I got in the stock market and in bonds. I own bonds, I own CDs too. In fact, I think now's the time to buy bonds and CDs to lock in the current rate of the yields before the Federal Reserve does lower rates this year. So I'm a macro investor. I invest in multiple markets and think of each market as a separate component. I'm in gold and silver because I'm bullish, but as I said, I see them as a necessary to have them, because I got bond investments too. And look, I could be wrong in thinking this won't be a problem for a couple of years, and there's a sudden blow up. This happened to people in England 2 years ago. There was a sudden decline in their currency, which was quite shocking, and it happened when a new prime minister came in and said, look, I'm going to stimulate the economy by cutting taxes, increasing spending, and boom, they had to abandon that program. But there was turmoil there. Turmoil is something that we have seen in the past couple of years. Last year, we saw some dips in the market, but nothing that was too alarming. I think this year we may see things, continue to be quiet. I know we saw a dip in the beginning of this year. Some stocks are off their highs, but look at how much we went up in December, got extremely overbought. So it's natural for a dip or consolidation to play out in the stock market. That seems to be what is going on with me, or to me, with the markets. But gold, silver, 2024, I think is good for both, but I think they're a necessity to have, well balanced portfolio. So if you want more from me, click the subscribe button, click like, and then YouTube will send you a alert the next time I have a video up. And hit the like button, put your comments in the section below so we can see what you think about the markets this year as we started out? Are you bullish on gold and silver? If not, why? If there's something more bullish you are on, tell us. We want to know what is going on and what other opportunities. I've talked about other opportunities too to start out this year. I talked about REITs, talked about utility stocks, and I'm looking at other stuff too. So be talking with you later.